Good morning and welcome to this webinar on the taxation of the digital economy. I'm Sarah Wolf-Cochrane and I lead tax policy at UK Finance. Thankfully, you won't be hearing too much from me this morning. I'm handing over to colleagues from BDO who are much better informed and able to deal with your issues and questions than I could. Really pleased today to be able to say Ross, David and Ben from BDO are going to take us through the issues and hopefully you'll ask lots of questions and we'll be able to get the most out of this session.
So thank you, Sarah. Thanks for that. It's David Britton here. I'm a partner at BDO, specialising in banking tax. You'll hear from me in more detail shortly, but I thought if we just set the scene in terms of what we're running through today. So Ross is going to take us through the OECD proposals as they currently stand and a little bit of where we've got to in terms of the journey here and on the taxation of the digital economy. And what is really important, I think, and conversations that we've been having with Sarah is actually what is the major impact that we're seeing for banks and in particular financial services as a whole, and what the implications could be if currently enacted or proposals as they're currently enacted are put forward. So I'll be talking along with my colleague Ben here around some of the impacts for the financial services, and then we're going to look a bit later on at what happens next. So without further ado, if I hand over to Ross to just give you a bit of the overall flavour and background and where we're looking for in the future from the OECD.
Thank you very much, David. So just by way of brief introduction, I'm Ross Robertson and I'm an international tax partner. And I've been following this debate around taxation of the digital economy for a number of years now. And I just wanted to spend a bit of time first taking you through the journey of how we've gotten to where we have gotten to, because I think it will help you to get your heads around where we might be going as well. So the debate around taxation of the digital economy might have started with big tech business, but it has now spiraled well beyond those ambits. If we put it into a political construct, the OECD BEPS project was effectively built on a desire to eliminate the non-taxation of income within international value chains. What we're talking about now with the taxation of the digital economy is really a perceived risk that the current international tax framework is not fit for purpose because it doesn't allocate profits between the entities within an international value chain in an appropriate way. And the perceived risk here is really that we've got an international tax framework that's now over 100 years old and has been built firmly around the premise of taxation by physical presence. That's both in the context of our existing definitions of taxable nexus with the permanent establishment definition, but also if you think about the way transfer pricing currently operates with focus on functions, assets and risks, and often physical performance of the functions associated with assets and the management of risks. So very much a framework that is built around taxation by physical presence, but we've got a business environment where businesses are increasingly able to participate in the economy of a jurisdiction without having physical presence and therefore without triggering a taxable nexus under the current rules. And that is triggering a lot of political unease as to whether the current international tax framework is fit for purpose. So we've got work ongoing at the level of the OECD to effectively review and revise the international tax framework. That is something that is requiring multilateral consensus because it requires changes to treaty and changes to basic definitions of what is required to trigger taxable nexus. As that debate goes on, we've also got various countries looking at unilateral measures to deal with some of the tensions whilst we wait for global consensus to emerge, and we'll come on to talk a bit more about that. But ultimately what we're heading towards is a reallocation of taxable income for certain global businesses. and we're going to see likely a more complex compliance web, at least in the short term, subject to exactly where the OECD get to. So in terms of the timeline so far, just wanted to run you through some key events. This is not a new debate. It really kicked off in the early part of the 2010s and was acknowledged within BEPS Action 1, which dealt with issues arising from the digital economy. And the final report in 5th of October 2015 resulted in wide-ranging changes to, in particular, the indirect tax landscape, with about 125 countries changing their rules on the indirect taxation of e-services. But it also acknowledged that there was an issue still to be addressed in relation to direct taxation. And effectively, what the report concluded was it was a complex issue to resolve. Let's see how far the remaining BEPS action items get us and then revisit the question. And what's really happened since then is that we've seen an ongoing proliferation of digitalisation of business models, increasing ability of businesses to operate remotely through reliance on technology, which has caused the OECD to accelerate its thinking again and put it back onto the international agenda and really try and move it forwards at pace. So we saw various reports come out of the OECD and the UK and the EU proposing what the way forward might be. We saw OECD paper in early 2019, which was effectively trying to group some of those different proposals together and find areas of commonality and areas of difference with a view to moving on the debate. And then a couple of weeks ago, we saw the OECD publish what it's terming its unified approach on the 9th of October, which is essentially trying to draw together the commonalities of those prior proposals, put forward with a view to finding a solution that members across the OECD can agree to and move forward. Where the OECD is hoping to go with this, it's hoping to have agreement in principle on what the future tax model should look like by January 2020, with then an issue of a final report and final proposals effectively by the end of 2020, with implementation to follow thereafter. So you can see that it's really looking to move very quickly by OECD standards. So let's spend a bit of time talking about what the OECD has proposed. And back in its paper in January of this year, it proposed breaking down this debate into two pillars. So Pillar 1 is addressing what they've termed the broad challenges of the digital economy. And this is really with a focus on the allocation of taxing rights in a way that's fit for the way the modern economy operates. And there were three proposals presented, which we'll touch briefly on in a minute. Then you've got Pillar 2, which they termed as addressing the remaining BEPS issues. So this is built on the premise that even in a post-BEPS environment, it is still too easy for a multinational organization to control the amount of tax it pays through the control of its internal functions. So what this is looking to do is effectively introduce a global minimum tax to stop a race to the bottom on corporate tax rates, and to therefore remove the incentive that perhaps exists today for some businesses to seek to manage their effective tax rate through location of functions, assets and risks in low tax jurisdictions. So today we're really going to focus on Pillar 1 because that was the focus of the OECD's paper that was released a couple of weeks ago. Just to touch quickly on the three original proposals, because it's relevant to the unified approach that the OECD has now presented. The three proposals in the January 2019 paper were the user value creation proposition put forward by the UK, the marketing intangibles proposition put forward by the US, and I understand it's supported by China, and then the significant economic presence proposal, which was put forward by India and other developing nations. And the user value creation proposition was built on the premise of the UK saying, we've got this issue because of highly digitized business models, and any solution should be restricted to those highly digitized business models. So effectively saying that the likes of large global consumer brands, the tax system currently works effectively for them, and really we should be focusing on certain very specific areas of big tech business. The marketing intangibles proposal put forward by the US was built on the construct that really the issue with the current transfer pricing framework relates to the under-reward of local marketing intangibles where we're selling into a jurisdiction and the market is not being rewarded appropriately for that sale. And the significant economic presence proposal put forward by India is that really the issue is one of remote selling, and therefore we need to create a new taxable nexus by reference to the activities that a remote seller undertakes, and that we need to allocate profit to that new taxable presence in a very formulaic way, because if we don't go formulaic, we end up having a very complex system which India and other economies will struggle to operate in practice. So how is that then translated into what the OECD has put forward? Well, essentially, the OECD proposal tries to acknowledge all of those proposals. It acknowledges the UK's view that the issue is one that is certainly relevant to big tech businesses and businesses where the users are actively contributing within a business model. But it says, actually, we think that the issue is wider than that, and we don't believe it's appropriate to ring-fence the solution to just those businesses. So we're going to bring in this concept of the US marketing intangibles approach as well, and recognize that there needs to be greater profit attribution to local market jurisdictions because we think the current transfer pricing framework is failing in delivering the appropriate returns to those market jurisdictions. But then it also acknowledges that the likes of India and other developing nations need to be able to administer the system, as indeed do the taxpayers that are going to be subject to this system. So it seeks to bring in components of the India proposal in relation to an extent, how it's defining taxable nexus under the new world, which we'll come on to, but also how you go about attribution of profit to market jurisdictions through fairly formulaic means. So just to touch on a couple of the areas that I think are quite important in relation to this. First, in terms of scope, the OECD Action 1 report said that they don't think it's possible to ring-fence the digital economy. However, the OECD unified approach is seeking to ring-fence the digital economy to a degree. And what they're saying is that the rules should apply to what are being termed as consumer-facing businesses, where consumer-facing businesses would also include businesses where there are active user platforms as well, and revenue is derived in some way in connection with those user platforms. So that in itself is an interesting development because it's the first time that the OECD has given ground on potentially restricting the application of scope, and that's something that we'll come to talk about a bit more. On scope, the OECD is also saying that these rules should apply to only the largest or larger businesses in the world, with the suggestion that maybe the country-by-country reporting thresholds of 750 million global turnover might be an appropriate measure of whether the new rules should apply to a business. And again, we'll come to talk about that in a bit more detail. So subject to being a consumer-facing business and having sufficient revenue under whatever metric they decide to settle on, what the rules say is that they're going to create a new concept of taxable nexus. So they're not going to change the existing permanent establishment rules. They're going to insert new provisions into tax treaties and into domestic law, which would create a taxable nexus where a business sells into a market and has sales above a particular threshold, regardless of whether the business has got any particular physical presence in that jurisdiction. So very much like the India proposal of a measure of sustained economic participation in the market, giving rise to a right to taxation for that market.
Is there any indication yet how those different regimes will interact, or is there no need for that to be spelled out at this stage?
So at this stage, the OECD has only gone as far as acknowledging that double taxation is bad for everyone, and there needs to be mechanisms to ensure that whatever framework is put in place, there are measures that both prevent the risk of double taxation in the first place, but also provide a mechanism to relieve double taxation if it arises. The issue we've got is that they haven't put any flesh on the bones of that at this point in time, so that is still very much a question of detailed design yet to happen. So if you've got a business which is in scope and above the threshold and you've created taxable nexus in the jurisdiction, then there will be an allocation of part of the profit of the global organization to that location. And we'll spend a bit more time talking about the detail of this later on, but in broad context, what they're looking to do is to look at the global profits of a group, carve out what is considered to be a routine return, and then look at what profit is left, and then a proportion of that deemed residual profit that is left will be allocated to the jurisdictions in which there is this new taxable nexus by reference to proportion of global sales within each market. So trying to go a fairly formulaic way, but as we'll come on to, there's quite a few challenges in actually practically achieving that. Then we've got another concept being brought in, which is that the OECD is saying they don't think that current transfer pricing rules work in terms of the reward attributable to sales and marketing functions in market, and therefore they're proposing that effectively they'd look to do away with transfer pricing benchmarking in respect of those activities and instead bring in a fixed return based on an assumed baseline of activity of a typical sales and marketing entity. So exactly, again, what that fixed percentage return would be and what it would be calculated on, whether it's on cost or sales, remains to be determined. But they're looking at trying to simplify, in their view, current rules by having a fixed allocation to sales and marketing jurisdictions where you have existing physical presence. So this would be a tweak of the transfer pricing rules that already apply today. And then you'd have the final piece, which would be a top-up, effectively, of if you had an entity in market whose activities went beyond the assumed baseline in that fixed profit allocation, then under existing transfer pricing construct, there would be an ability to attribute further profit to that entity, subject to robust dispute prevention and resolution mechanisms. And those dispute prevention and resolution mechanisms, again, remain to be defined, but they've sought insight into how effectively things like APAs and mutual agreement procedure, etc., work today. So it might be some combination of things that we're used to, and it might be some new additions to that as well. So that's really the focus of what the proposals are talking about. And if we spend a bit more time talking about the profit attribution, because I think this is the piece that is sort of garnering the most attention at the moment and which has the potential to be the most controversial. So I mentioned that effectively you've got the new taxable nexus with allocation to that. You've got a change in transfer pricing for sales and marketing to allocate a fixed return, and then you've got a top-up mechanism. The OECD proposal refers to this as amounts A, B, and C. So amount A is this deemed residual profit, which would be allocated to a new taxable nexus. And the interesting points about amount A are that from the conversations that I've been having, the suggestion is that this is the area where we're really talking about in relation to scope. So this area, this particular amount would be applied to large consumer-facing businesses. In terms of the rules that are proposed to change the transfer pricing rules more broadly, those are potentially applicable to all businesses regardless of industry and regardless of scale. The OECD report is not totally clear on that, but that seems to be the suggestion that I've been getting from various conversations I've had with the OECD and others within the EU. So if we focus on amount A, we've got attribution of part of the residual profit to the market jurisdiction, likely based on sales. What's that likely to look like in practice? Well, the OECD paper itself does not provide any details in terms of numerically, but from talking to UK government and others within the EU, we've got a sense of what it might look like. And there seems to be commonality starting to gather around a concept that you look at the group residual profits and you then take away 10% of those as a deemed routine return. That leaves you with a residual profit, and then you work out a proportion of that which would be subject to reallocation to those territories in which you've got taxable nexus by virtue of selling into a jurisdiction. And how much of those profits is to be reattributed is not defined by the OECD, but I've heard people talking about it as anywhere between about 10% of that residual profit over the 10% routine and about 50%. So it's still a very wide range. I think what's interesting is when I talk to people in the UK, they're expecting 10% over 10% or perhaps 20% over 20%. When I talk to people in the EU, they're expecting that, yes, you might have the 10% routine return, but the attribution of profit above that could be as high as 40 or perhaps even 50%. So even within a few hundred miles of London, there seems to be a lot of sort of disparity in what people expect ultimately to happen. And I think that's a very relevant point here, because ultimately what we're going to end up here with is a political compromise. These rules will result in winners and losers in terms of countries. So countries like Ireland, for example, stand to lose potentially fairly significantly because their economies are built on effectively being the owners of the residual profit. And a reallocation of that residual profit away from Ireland is likely to reduce Ireland tax take, similar with Switzerland. Whereas other markets potentially stand to gain, particularly the developing nations like India, so on, where they've got very large consumer bases and would probably do well under a reattribution of global residual profit, where they wouldn't have to give up much in the way of residual profit on organizations set up within their own boundaries. I think the biggest questions remaining in relation to Amount A, apart from which businesses are in scope, which will be part of the discussion we come on to have, is around this question of how much profit is reallocated, but perhaps more importantly, where is the profit reallocated from? There's an assumption in the OECD example, which we'll come on to in a second, that it will just be obvious where the residual profit sits, and you'll just take the profit out of that box and put it into the market jurisdictions where you've got new taxable nexus. I think the reality of multinational businesses is much more complex than that, and is something that we'll need to sort of input into the debate to ensure that the OECD and other governments really understand quite how complicated it might be for a large multinational organization to work out where that residual profit comes from in order to prevent double taxation. If we talk briefly now about Amount B, so this is the fixed return for baseline sales and marketing activities. As I said, this is something that potentially applies to all businesses, not just consumer-facing businesses and not just large businesses. That remains to be determined, but it seems sensible to me that we could be heading in that direction, given that Amounts B and C are effectively trying to simplify and improve the existing transfer pricing framework. As I said, Amount B would only apply where you've already got taxable nexus under the existing rules by a permanent establishment, physical entity, whatever it may be, and it's just tweaking how much profit would be attributable to that entity. Likewise, we've then got a question in relation to Amount C of a top-up under existing transfer pricing principles. Again, I see this more as a tweak to existing rules rather than something that's radically new. I think the new piece will be how they manage the resolution and prevention of disputes and how creative businesses can get, or tax authorities, can get to help businesses to manage that. And then just a final point on all of this, I think there's a big question outstanding in terms of how the administration will work. There's a sense that the OECD is currently looking to apply 20th century concepts to solving a 21st century problem, by which I mean that effectively they're creating this idea of a new taxable nexus, which immediately invokes ideas of registration and compliance obligations and so on. And actually, I think where we need to take the debate is there a better way to do that in a digital world like we have today. So, for example, one of the areas that's gathering a lot of support currently in the UK is the idea of a one-stop shop, whereby when you're calculating amount A, you would file a single tax return to your global or to your head office tax authority, and that would determine how much profit is attributable to amount A and how that is allocated around the world. You would then perhaps file simplified tax returns to the jurisdictions where the reallocation happens to, preferably with no form of registration or taxable compliance obligations there to minimize the cost. And then you would leave it to the tax authorities to agree amongst themselves whether the calculation of amount A and the reallocation of that amount was appropriate, and they would only come back to you if they could not agree on that. So that's what is garnering a lot of support. Whether we'll get there remains to be seen. So just in terms of quickly running through the OECD example, which, as I said, is not particularly helpful because it assumes that businesses are much more simple than it is. But we've got a group which provides streaming services, has no other business lines, which is an area where there's further debate going on because there's the potential for different business lines to have different levels of profitability, and therefore we need to think about whether there's a need to segment by business lines. So this group is highly profitable, earning non-routine profits, and it has a presence in another country, in QCO, in resident in country 2, and it is already undertaking marketing and distribution functions there. There would be a fix of the return that entity gets. There would be the creation of a new taxable nexus in relation to the sales into that territory, which would result in a reattribution of part of the global residual profit to that new taxable nexus. So very, very simplified example, doesn't really tell us an awful lot, but that is where we are at the moment. So then just to quickly touch on Pillar 2, this concept of a global minimum tax. This wasn't addressed in the OECD's paper. We're expecting a paper on Pillar 2 in early November, with a public consultation then happening in December. And I suspect it makes sense for us to spend more time talking about it at that point in time. But the point here is that this global minimum tax would operate effectively by way of a super CFC rule, whereby the parent jurisdiction would have a right to tax any profits that are not subject to a sufficient level of taxation in the local market. And that would be regardless of whether there is sufficient substance in that market to justify the return under current transfer pricing principles. And likewise, there would be a tax on base eroding payments, which would consist of either a lack of deduction for payments being made to an entity which is not subject to tax at least a sufficient rate, and or potentially the application of withholding tax to payments that fall into that bucket. So again, still a lot of design to happen, and we'll find out more with the OECD's paper in November, so I don't propose we spend any more time on that at the moment. And I suppose the final point that I'd close on from me is that there's a lot of countries in the meantime that think that things are proceeding too slowly. So notwithstanding that the OECD is looking to move forward at pace with agreeing a final solution by the end of 2020, there's a number of jurisdictions that say, well, this is a current problem. So you've got a series of unilateral measures being introduced around the world. And examples of that would be the digital services tax in the UK, which so far HMRC has refused to be drawn on whether it still plans to go ahead with the DST, notwithstanding the OECD's latest paper. So we're still assuming that the UK does intend to press forward with that. We've seen similar measures in France. India's already got effectively this significant economic presence construct, and China has got an enterprise income tax and various other taxes that apply to digital businesses and digital services. And these are but a few, and we'll come back to at the end of this webinar a tool that we've developed to help you track. So I think the key point is that whilst this global debate is going on, it's worth noting that there are some countries that are already moving, and it will be important to keep track of those developments and ensure you can continue to apply going forward.
And And Ross, that's great, because I think there's a good point to take stock and think about what this all means to financial services and the banking industry as a whole. I think it's a good point just to start before we move on to the OECD proposals is have a look at, the digital services tax in the UK. Now, clearly, they have put in exemptions in the legislation that is excluding some financial services and banking industry, but the wording is quite narrow. So whilst some banks and some financial services institutions might think that the digital services tax in the UK does not apply to them, actually when you read the finer detail of the legislation, actually it really relies upon some of the regulatory constraints or regulatory approvals that you will get. And therefore, whilst you may be sitting there thinking that you're not caught by the digital services tax in the UK, actually you may well be, and you really will need to look at the definition and see whether you do fall within the definition of financial services exemption and as it currently stands in the digital services tax world. However, let's just flip that on to what we mean now in terms of what we've just heard from Ross around the OECD proposals. And I think if you go back to what Ross said at the start, actually there are currently no exemptions for financial services in the proposals. Whilst we are looking at what the OECD have said, as Ross said, potential exemptions for some sectors, and they have indicated that the financial services may be one of those. At the moment, as they stand, banks and financial services institutions will definitely be falling within the digital tax economy. And I think it's, whilst it's the taxation of digital economy, as Ross said, the way the definition of nexus looks at, you could quite easily fall within the rules or inadvertently fall within the rules. And then for what does that mean for banks and financial services institutions? Well, not only just the admin burden that Ross said, but also where does that affect your tax paying and your effective tax rate? So you really need to start thinking about this and what the impact is. Now, fortunately, it's not too late to lobby and start to talk to the OECD about this. Now, I think it's probably worthwhile just spending a few minutes in terms of thinking about the banking sector and some of the arguments that could be put forward as to why banks or financial services should be excluded. Now, over the next few slides, we're showing what the International Banking Federation have put forward as potential arguments as to why banks should be excluded from these proposals. Now, I think from the outset, when you look through this, I think whilst we definitely agree with this in terms of why banks should be excluded from the legislation, I think what is important to note is that when you read the International Banking Federation's letters to the OECD, the definition of a bank is quite narrowly drawn. So they are really looking at regulated deposit-taking institutions, which, whilst most of you would be in terms of it, but there is clearly a broad number of people listening here and other members which would not fall within the definition of a deposit-taking institution. Therefore, there needs to be ideas or arguments to be had as to why you should be excluded from this, or if not, you need to start planning as to what the impact would have on your businesses for the OECD proposals. Why do banks differ from other businesses? And I think the main thing that they draw upon is banks are required to have regulatory licenses where they operate. Now, obviously, that is in certain instances, and as we said, this is about deposit-taking institutions. But if you are heavily regulated and you can't just go into a jurisdiction without the license, therefore, you already typically are creating a permanent establishment nexus where you are required to have that license. So you are heavily regulated business. You have to abide by the regulatory regulations in those jurisdictions, aside from what we say here in terms of obviously the EU passporting system, but still there is oversight and governance that is required in jurisdictions. You are required to have regulatory capital obviously, this is monitored on a regular basis, and you need to be ensuring that you retain adequate buffers and liquidity targets. Now, I think the main thing there is to say that, highly regulated, you have to be in jurisdictions that are regulated for your licenses, and therefore you're taxed already in the jurisdictions that you are regulated in. Therefore, why should you be attributed any additional profits because of the digital taxation?
I think in the UK, we've also got the additional risk. We had the ring fencing of UK retail banks, so there'd be a lot of deposit takers that the retail bank is, but then the separate corporate and investment bank, which is being ring fenced, which is often the more global piece, wouldn't necessarily fall within the narrower definition as a deposit taker. So that's obviously a big risk in the UK.
Yeah, and that's right. And I think the other thing to think about is that within the financial crisis, clearly a number of banks were supported through the governments, propped up by the governments, and I think there's a fair assumption, and what the governments would argue, which had to prop up some of the global banks and some of the local banks, is that, well, we've supported those banks, we've changed legislation as a result of that, introduced other taxes, we've introduced stringent regulatory barriers to operate, and therefore we should be remunerated for taking on that risk, and we should be having the fair tax take of that jurisdiction. So why should a bank, whereby you may have a consumer in a low tax jurisdiction or in a different tax jurisdiction, why should they benefit from that when actually the host country is taking that risk of that entity potentially collapsing or going under? So I think, through here you can see that the International Banking Federation have come up with a number of reasons, and they take you through all of it's a mismatch of what the OECD originally proposed. And I think this is really important, that this is only for banks that are deposit taking. And I think that the interesting thing here is what do we need to be talking about in terms of if you don't fit within that definition, and what should you really be looking at? So I'm thinking here, the fintech world, the payment service providers, or actually you have a number of entities that aren't actually regulated within your banking business. And so how do you deal with entities like that, or if you're in that type of business that isn't necessarily heavily regulated? And I think the main thing here is to come up with some case studies that you need to look at in terms of, well, actually, the way I'm being taxed now would not fundamentally change under the new basis or the tax take that the OECD is proposing. So, for instance, if you're a payment service provider that has e-money licenses across the world, and you are paying taxes or branches, you have branch permanent establishments in those jurisdictions, is your regulatory requirements of sufficient rigor to ensure that you would have a taxable presence in that jurisdiction, and therefore you believe that your consumer-facing or consumer-taking activities are sufficiently in those jurisdictions to be taxed as they are currently, rather than nexus elsewhere? And so I think in that respect, it's very, very important for you to have a look at that and see whether, and I think probably the best arguments, and I don't know whether Sarah's got any comments, but I think the best arguments would be that you look at your regulatory regime to see whether you can come up with arguments around that, rather than trying to just completely disapply the rules and say they should not apply to financial services.
Yeah, I think you're right, David. I think, we've had a clear steer from the OECD Secretariat and governments that saying we're regulated isn't enough, and we have to make the argument that connects what it means to be regulated as to what the implications are for your presence and for your activities and how you're taxed. And I suppose, looking at what the IB Fed have done is kind of they've been connecting those and looking at, well, if you're looking at a consumer-facing business, what prevents, the sale of mortgages or whatever across borders. But we clearly have to go further. It's developing those arguments and landing them and ensuring that that whatever answers we come up to are going to have the rigour that they kind of survive the long haul, and I think that's one of the challenges we also face.
Yeah, because I think the classic example within financial services, I mean, there's already quite a lot of examples within the industry, and also the OECD has done a huge amount of work over the years on financial services. I mean, part 3 of the report on the attribution of profits to permanent establishments covers global trading books. So banks with 24/7 global trading books. But that all links back to key entrepreneurial risk takers, which is all about the people making the decisions. But as we've seen technology develop, we're having more and more AI and more decisions being made by computer. So now when those kind of trading decisions are made, if you've got an algorithm or something else, actually the decisions are no longer being made by people on the ground. They're being made centrally in a system somewhere. Somebody's written a clever algorithm, and that's where, there's a trade that's done, but it might be executed in Hong Kong, but it's made in London by a machine. So I think that's the kind of issue that needs to be covered in the lobbying, and thinking about how regulation covers that and whether or not we can carve out an exemption for financial services. But that's where I see the key crux of the complication in getting an exemption, because my heart wants an exemption, but my head's saying it's going to be hard to achieve.
And one thing I'd add to all of that is that this is a political debate first and a tax debate second. So we're not necessarily going to be able to drive the conversation forward solely through technical, economic, or tax arguments. I think that any lobbying should also include an assessment of how these proposals would impact you, both at a practical level in terms of the requirements that would place on your business in order to segment profits or whatever it may be, in the way that the rules are asking us to do, potentially, but also looking at beyond that, once we've got further clarity on what the profit attribution would look like, or what would actually the impact of that be in terms of reattribution of your profits, if you're able to demonstrate that it would have negligible impact for retail banking or whatever sector you operate in, then you'll be in a pretty strong position to argue that you shouldn't be subject to the compliance requirements associated with what would yield very little ultimate difference in the tax outcome. On the other hand, if you run those numbers and there is a significant reattribution of profit, then you need to find even stronger arguments to try and justify why it's not appropriate for those profits to be reattributed, bearing in mind it is a political question more than it is a tax question, I think, at this point in time.
Yeah, and that's right. And I think the important thing here, as we're saying, is it is going to impact you as it currently stands. There is no exemptions as it currently stands. You need to be in the market talking to UK Finance, other member bodies to put forward your case as to why or if an exemption should apply for financial services, but coming to the conclusion as to what does the impact mean to me if it doesn't. As Ross said, I think it is important that you go through this and look through, not just because it's going to cost you more money, but actually come to why, and looking at regulatory and other aspects as to why you should be looking for the exemption. So Ross, in terms of what you think the future holds and where we go to now?
Yeah, so I think what we're starting to see, and we've seen this through the digital services tax, and we've started to explore it through the debate today, is that certainly government in the UK, and probably government more broadly, is very wedded to the idea of trying to tie scope by reference to an existing regulatory framework or existing legal framework where possible. So as an example of that, I've heard that the UK government is keen to try and define consumer-facing business by reference to existing consumer law. So I think we're going to have potentially a similar dynamic start to emerge when we get into what a financial services exemption might look like. I think there's going to be a desire to pin that on regulatory framework where possible. I think that we've spoken about the size threshold currently proposed at 750 million of global turnover in accordance with the CBCR standards. I think we're going to see pressure on that dropping down. There's already pressure on that, I understand, from a CBCR perspective, that maybe that threshold is a bit too high. We're seeing a drive towards greater transparency, and therefore anything that is pegged to CBCR or a similar measure is likely to face downwards pressure rather than upwards pressure. So I think we are going to see that global threshold come down. As I've said, ultimately, this is a political question of profit attribution, and economic rationale will only get us so far. Ultimately, you're going to need to have a view reached between the winners and the losers in this debate as to what an acceptable outcome might be. In that debate, you're going to have a balance between the pot of gold that the developing countries feel has been promised to them of reattribution of all of the profits of Google and other large tech businesses, for example, being sufficient for them to feel like they've really won, but also at the same time, the US or other nations that stand to lose not feeling like they've really lost and that they're still capturing appropriate value from the businesses that are established within the framework of their national infrastructure, which I'm sure they would argue contributes to the success of those businesses. I think we're going to need to see some further thought in terms of business line segmentation. So the OECD examples are very, very simplistic. Many businesses will operate what are potentially in-scope business lines alongside out-of-scope business lines. Even where all business lines are in scope, there will be very different profit margins and different operating models applied to different business models. What I've heard is a desire to investigate a sort of tax risk matrix approach, which the Australian Tax Office adopts from a transfer pricing perspective, whereby the margins and profitability of different industries are benchmarked to enable the Australian Tax Office to effectively assess transfer pricing risk. I think we're going to see some sort of similar matrix which will acknowledge the different profit margins of different sectors as an overlay to this. I think we're going to see a need to find a balance between accuracy and administration. And so what I mean by that is that I think if you go into a room with a bunch of academics, then they would probably take you down to the nth line of detail and say, well, if we do it in this way, then it will create distortion, and therefore we need to find solutions to solve all of these potential distortions. That will create a very complex and difficult to administer system. On the other side, you could say, well, if we go too simple, then we lose some of the nuance around different profitability by business line. And so we need to find the balance between what is a simple enough regime to administer which still gives a reasonable outcome at global scale. So I think that there is very strong political will to move forward and move forward at pace. I do think that the OECD will achieve what is likely to be a very ambitious timeline, and I think businesses need to prepare for that. In terms of what actions I think you should specifically be focusing on now, as we've heard, these proposals are still in a formative stage. There is scope to shape them as part of the public consultation process. So do feed in your thoughts via UK Finance or direct to the OECD as to what it would mean for your business to ensure that whatever change comes is something that you could manage in practice. I think there's no point in trying to deny change at this point. The political force behind this change is too great. The best you can hope to do is to shape that change by actively engaging in the debate. Whilst that debate is ongoing, as we've noted, there is change already happening at a unilateral level. So do continue to monitor those changes. And we'll come on to show you the tool that we've developed to help you monitor some of those changes at global scale. And I think as well, think about it from a data perspective. So when you start to think about what these proposals might mean for your business, how would you collect the data that would enable you to make the sorts of assessments that the OECD is requiring you to make? Appreciate there's not a lot of detail in the OECD paper, but if you just start thinking about, the different profitability of business line segments, do your systems currently allow you to segment your business by geography, by business line, in all of the different ways that are potentially mentioned in the OECD's papers to date? If not, and you're looking at systems change, then there's a long lead time to that. So start thinking through how you'd get your systems in shape to enable you to comply. So as we mentioned, there are a lot of changes happening at a local level, and we've been developing a tool which we'll be launching shortly, which tracks what changes have been happening around the world, both in terms of direct tax, indirect tax, as well as any other new taxes that have been implemented. So this is what that tool currently looks like. And effectively, it's a map, and you can float around the map and see where there's been change that's happened in a local jurisdiction. The idea is that you can then map that to your organization and see which territories maybe warrant a bit of a closer dive for you. So, for example, if you're currently selling into Turkey, where there's been some new rules enacted, you can click into Turkey. In Turkey, actually, we've had both a value-added tax change as well as a withholding tax change. You can click into the value-added tax change, for example, and it will give you an idea of, okay, well, which types of business are potentially in scope, because some of these rules are very targeted at tech businesses, for example. This tax in Turkey is actually fairly broad in practice, but again, with a bit of an online focus. And then you've also got what sorts of revenue streams are in scope, so you can map against your business as well in terms of whether you're undertaking that sort of business and receiving that sort of revenue. And then if you've got a desire to find out more, then you can click through and you can get access to the relevant contacts. That's just an idea of the tool that we've got to help you monitor global compliance across your business, and we will look to roll that out to you as soon as we're able to do so.
Thank you, Ross. That's the end of our presentation, but there is still obviously time for questions and answers. Now, if you could, in the bottom right, you'll see in the screen, you'll see a box, drop-down box, where you can post your questions. If you could do so now, we will seek then to respond directly to you.